Okay, so before we looked at markets and how they worked, and we drew an axis, and we had large companies, small companies, value companies and growth companies. And we knew, or we saw rather, that by investing into the whole market we got an 11.2% dating back to 1970. We even looked back at the data to 1956 in some places as well. And then we also saw that by investing into small cap and value cap companies, we got in the region of a 14.2%, 14.7%, and we saw those dynamics in the book. So what I wanted to just do was show you the reality of what a pound grew to over the period. So what I'm going to do, I'm going to start over here, and I'm going to draw from 1970, and I'm going to go to December 2021. The first line I have is RPI. So it's what inflation grew the pound to. And what we can also do in our book is look at exactly what inflation has done to us over the years. Let's just look at page 24 in our matrix book. This is the retail prices index. Now again, this goes back to as far back as 1948. But if we just look to 1970 and go all the way down, we'll see that RPI, the cost of living inflation, which I talk about as being the big problem in the initial presentation video, the big problem has cost us 5.7% on an annualized basis dating back to 1970. So that 5.7%, it basically saw the value of a pound rise to about £23. That's the reality of inflation over that period. Talk about fixed income and how that's also not a sensible investing strategy to get you through a 3-decade retirement. Let's look at fixed income returns. In my matrix book here, I can see fixed income defined in 1 month UK Treasury bills. And again, the data goes back as far back as 1955 in this case. But if we go back to 1970, we can see here that the returns from fixed income, symbolised by the 1 month Treasury bills, by UK gilts, UK bonds, 6.1%. So you can see quite clearly that by investing into bonds, it's not going to do much more for us. And in fact, the value of bonds from 1955 to the back end of 2021 grew a pound from £1 to £57. But a more recent example from 1985 to 2021 grew the bonds to £10. So somewhere in the region of £10 and £50 in that area is going to be a slight swing upwards for returns from bonds, but not a significant amount more. So then we had, call it the FTSE, call it the global stock market. We saw that they both returned, on average, a compounded return of around 11.2%. So what did that grow a pound to? Well, a pound invested in the global market from 1970 to 2021, it grew a pound from it grew the value of a pound to £252. So we've gone right up now from inflation through to bonds, which wasn't going to get us much more, all the way to £252. What about small cap and value cap markets? Well, if we'd invested in the global small cap market from 1970 to 2021, we would have secured ourselves a 14.7% return, and that would have grown the value of a pound to approximately £1,273. So we are up again there. The value cap markets, we saw the returns were also hovering around the 14% mark. And you can see quite clearly from these three dynamics, we've got retail prices index inflation. The pound obviously has to keep pace with inflation. So the value of a pound in 1970 was worth £23 in 2021. We saw examples of fixed income bond returns from 1985 to 2021 doing just £10, and then from 1955 all the way through to 2021 up to £57 as a max. So if you said even over that huge period of time returns would only have secured £57, you can see the problem. This is the fixed income issue. This is fixed income here, this is RPI here, this is global equities here, and then you've got this cap, this small cap and value cap, northeastern quarter, where we point the portfolios. And it's through the inclusion of these assets, these equity assets, that we were able to secure these higher returns all the way up the pendulum. Now here's the thing, as we all know, these markets don't just go up in these straight lines. What they do is they move up and down, don't they? And we see this all the time, and I've done many videos which are available to you now as a course subscriber, which chart out all of the stock market crashes all the way back to the year I was born in 1972, and you can see quite clearly we've been through so many different challenges over the period of time. But here's the thing, the advance has always been permanent and the falls have always been temporary. So one of the biggest parts of my job for you, one of the biggest parts of our job in looking after your portfolio, will be to stop you from causing significant self-harm when these falls come, which they do on a regular basis, every 3 years, every 5 years. The falls have been temporary, the advance has been permanent. You should write that down literally somewhere where you can see it on a daily basis. This is just price gyration, this is not risk. This is a big misconception. Our global portfolio at the moment has something like 15,500 stocks in it. That's through the UK, that's through the global equity market, it's in the developed world, and it's in the emerging world too. Is there really any risk of holding 15,500 listed securities? I don't think there is. I think the only thing you would ever see is this gyration in prices. What people confuse risk with is that they think risk is it moving up and down. You would have a risky investment if you were to be singling out individual companies through a stockbroker or an active manager. If you were investing your pension into just one country or one sector or one asset class, clearly that's going to come fraught with massive risks. We don't do any of that. We put you into a balanced portfolio which incorporates something like 15,500 stocks. And just for the record, right now, about 4,500 of those equities, those stocks, are classed as small cap and value cap, which would give you access to those higher expected returns that we touch on. So there we have it. We stay calm, we stay in for the longer term, over any decade, over any period of time, remembering always that retirements last in the region of 30 years, and we just stay put with clever portfolio design, with clever management of costs, and with a sensible approach and an evidence-based approach to investing.